What if I told you that the United States government doesn't actually control the economy anymore? What if the Federal Reserve, the Treasury Department, and even the president are just the public face of a system that is really run by a single private company managing over $10 trillion in assets? A company that owns pieces of nearly every major corporation in America. A company that advises the government on policy while simultaneously betting on the outcomes of those same policies. A company that's literally too big to fail, because if it goes down, the entire global financial system collapses with it. That company is BlackRock. And here's the part that should terrify you. You're paying for it. Every time inflation eats into your paycheck, every time your rent goes up, every time you look at your retirement account and wonder why it is not growing the way they promised, you're funding a system designed to concentrate wealth and power into fewer and fewer hands. BlackRock isn't just participating in the economy, it is the economy. And the mechanism that gave them this power? It's the same one that's going to trigger the next financial collapse. Except this time, there's no bailout big enough to save us. Before we dive into the receipts, do me a favor, drop a comment and let me know where you're watching from. I want to see how global this audience really is. And if you are tired of surface-level explanations and want the unfiltered truth about how money and power really work, hit that subscribe button. You're going to need it for what's coming. Let's go. To understand how BlackRock became America's shadow government, we need to go back to 1988. That's the year Larry Fink, a former bond trader at First Boston, launched BlackRock with 8 partners and a single mission: use technology to manage risk better than anyone else on Wall Street. At the time, Wall Street was still reeling from the 1987 crash, and firms were desperate for better ways to predict and control risk. Fink had just lived through a personal disaster. He'd lost his firm $100 million in a single bad bet on mortgage bonds. That failure became his obsession. He built a proprietary system called Aladdin, short for Asset Liability Debt and Derivative Investment Network. Aladdin was a massive risk management platform that could analyze millions of data points in real time, predicting how different assets would perform under different economic conditions. Sound familiar? Today, Aladdin doesn't just manage BlackRock's $10 trillion in assets. It manages over $21 trillion across thousands of institutional clients, including central banks, pension funds, and sovereign wealth funds. That's more than the entire gross domestic product of the United States. One company, one algorithm, controlling the risk calculations for a third of the world's investable assets. But here's where it gets darker. In the early 2000s, BlackRock started doing something no other asset manager had done before. They started advising governments. After the 2008 financial crisis, when Lehman Brothers collapsed and the entire global banking system nearly imploded, the United States Treasury Department didn't turn to the Federal Reserve for help. They turned to BlackRock. The Treasury hired BlackRock to evaluate the toxic assets on the balance sheets of failing banks like Bear Stearns and AIG. BlackRock wasn't just an observer. They were the ones deciding which banks lived and which ones died. And here is the kicker. BlackRock was also buying up the same distressed assets they were evaluating for the government at fire sale prices. Sound familiar? In 2020, when the COVID pandemic triggered the fastest market collapse in history, the Federal Reserve didn't just cut interest rates to zero and print trillions of dollars. They hired BlackRock again. This time, BlackRock was tasked with managing the Fed's emergency bond buying programs. Translation: BlackRock was given the authority to purchase corporate bonds and mortgage-backed securities on behalf of the United States government, using taxpayer money. And once again, BlackRock was simultaneously buying the same assets for its own clients, profiting on both sides of the transaction. Let me say that again. BlackRock was hired by the government to stabilize the market by buying assets. And at the same time, BlackRock's private funds were buying the same assets, knowing exactly what the government was going to do, because they were the ones advising the government. If that sounds like insider trading on a trillion-dollar scale, that's because it is. Except it's legal when you're too systemically important to prosecute. But the real conspiracy isn't just that BlackRock has a revolving door with the government. although they absolutely do. The real conspiracy is the mechanism that allows them to control everything without owning anything outright. That mechanism is called passive index investing and proxy voting power, and it's the single most underreported financial story of the last 30 years. Here's where the story takes a turn that most people don't see coming. When you think of corporate ownership, you probably imagine a billionaire or a hedge fund that buys a controlling stake in a company and calls the shots. But BlackRock doesn't work that way. BlackRock is the largest shareholder in almost every major publicly traded company in America. Apple, Microsoft, Amazon, ExxonMobil, JP Morgan Chase, Pfizer, Lockheed Martin. BlackRock owns a piece of all of them. But here's the twist. That money isn't BlackRock's. It belongs to millions of everyday investors who put their retirement savings into BlackRock's index funds. So technically, BlackRock doesn't own those shares. You do. But here's the catch. You don't get to vote on how those shares are used. BlackRock does. When Apple has a shareholder meeting to decide on executive pay or corporate policy, BlackRock votes on behalf of all the people whose money is in their funds. The same goes for every other company. This is called proxy voting power, and it's how BlackRock controls corporate America without actually owning it. Now, you might be thinking, okay, so what? They're just voting on boring corporate governance stuff, right? Wrong. BlackRock uses that voting power to push policies that benefit BlackRock. They vote for board members who are friendly to asset managers. They vote for executive compensation packages that prioritize shareholder returns, even if it means laying off workers or cutting wages. They vote against any policy that threatens the financial status quo. And because BlackRock, Vanguard, and State Street, the big three passive asset managers, collectively control over $20 trillion in assets, they have effective veto power over nearly every major corporation in the world. But it gets worse. Remember Aladdin, that risk management system I mentioned earlier? It's not just analyzing risk, it's shaping the market. Because Aladdin is used by so many institutions, its predictions become self-fulfilling. If Aladdin says a certain sector is overvalued, trillions of dollars move out of that sector, causing it to crash. If Aladdin says another sector is undervalued, trillions of dollars flood in, driving prices up. BlackRock isn't just reading the market, they're writing it. And here's the part that should keep you up at night. The person who built Aladdin, the person who advised the Treasury during the 2008 crisis, the person who now sits on multiple government advisory boards? You won't believe the name. Actually, you will. It's Larry Fink, the same guy who's been building this empire for 35 years. And the receipts for what he's really planning, they're wilder than you think. Let's break down exactly how the system works, because once you see the mechanics, you can't unsee them. The foundation of BlackRock's power is something called passive index investing. An index fund is a type of investment that tracks a market index, like the S&P 500. Instead of picking individual stocks, you buy a little bit of everything in the index. It's cheap, it's easy, and over the last 40 years, it's become the dominant way Americans invest for retirement. As of 2023, over $14 trillion is invested in passive index funds in the United States alone. BlackRock's iShares ETFs, which are exchange-traded index funds, are the largest in the world, managing over $3.5 trillion. Here's why that matters. When you buy a share of an index fund, you're not buying stock in a company. You're buying a share of a fund that owns stock in hundreds or thousands of companies. BlackRock pulls all that money together and buys shares in every company in the index. Because so many people invest in index funds, BlackRock ends up owning massive stakes in almost every publicly traded company. And because of proxy voting rules, BlackRock gets to vote those shares however they want. Now, let's talk about concentration. In 1990, the top 5 shareholders of a typical S&P 500 company owned about 15% of the company's shares. Today, the top 5 shareholders own over 25%, and in most cases, those top 5 shareholders are BlackRock, Vanguard, State Street, Fidelity, and 1 or 2 others. In some cases, the big 3 alone, BlackRock, Vanguard, and State Street, own more than 20% of a company. That means a tiny group of asset managers has effective control over corporate America. But here's where it gets truly parasitic. BlackRock doesn't just vote on corporate governance. They lobby for policies that make index investing more attractive, which funnels more money into their funds, which gives them more voting power, which lets them lobby for more favorable policies. It's a feedback loop of consolidation, and it's accelerating. In 2000, passive funds managed about $1 trillion. Today, it's over $14 trillion. By 2030, analysts estimate it could exceed $30 trillion. At that point, BlackRock and a handful of competitors will control more than half of all investable assets on Earth. Let's connect this to something you feel every day: inflation. When the Federal Reserve prints trillions of dollars and drops interest rates to zero, where does that money go? It doesn't go to small businesses. It doesn't go to workers. It goes into financial assets, stocks, bonds, real estate. And who owns most of those assets? BlackRock and the other mega asset managers. When the Fed pumped $4.5 trillion into the economy during COVID, the stock market hit record highs while 40 million Americans filed for unemployment. BlackRock's assets under management grew by $2 trillion in 2 years. That's not a coincidence. That's engineered wealth extraction. Here's another number that should make you angry. In 2008, the federal government gave the biggest banks a $700 billion bailout through the Troubled Asset Relief Program, also known as TARP. BlackRock was hired to manage the bailout. They charged fees on every transaction, but the real profit came later. BlackRock scooped up distressed mortgage-backed securities for pennies on the dollar. When the housing market recovered, those securities became worth billions. BlackRock made money on the bailout, made money managing the assets, and made money when the assets recovered. The taxpayers who funded the bailout, they got nothing. Many of them lost their homes. Fast forward to 2020. The Federal Reserve launched an emergency bond buying program worth $750 billion. Who did they hire to manage it? BlackRock. Again. And just like in 2008, BlackRock was buying the same assets for its own funds. The conflict of interest is so blatant it would be illegal in any other context, but because BlackRock is now considered systemically important financial infrastructure, they operate under different rules. They're not just too big to fail, they're too big to regulate. Now, let's talk about Aladdin, because this is where the moral hazard becomes existential. Aladdin is used by over 200 institutions managing over $21 trillion. That includes central banks like the Swiss National Bank and the Reserve Bank of India. It includes pension funds, sovereign wealth funds, insurance companies, and hedge funds. When all of these institutions use the same risk model, they all make the same bets. If Aladdin says sell, everyone sells. If Aladdin says buy, everyone buys. This creates massive herding behavior, which amplifies volatility. And when volatility spikes, markets crash faster and harder than ever before. Here's the terrifying part. Aladdin is a black box. Even BlackRock's clients don't fully understand how it works. It's proprietary. The algorithm is secret, but we know it uses artificial intelligence and machine learning to predict market behavior. And we know it has access to more financial data than any government or central bank. So when Aladdin makes a prediction, it's not just analyzing the market, it's moving the market. If Aladdin predicts a crash, its predictions can cause the crash. That's not risk management. That's market manipulation on a civilizational scale. And here is the kicker. Larry Fink has openly said that the future of finance is data and AI. BlackRock isn't just managing assets anymore. They're building the infrastructure of global capital. They're creating the operating system for money. And whoever controls the operating system controls everything. Let me give you one more number that ties this all together. In 2007, right before the financial crisis, total global debt was about $70 trillion. Today, it's over $300 trillion. That's debt owed by governments, corporations, and households all over the world. And who holds most of that debt? Asset managers like BlackRock. They own the bonds. They own the mortgages. They own the loans. When the next crisis hits, and it will, the only institutions big enough to absorb the losses are the ones that caused the crisis in the first place. And they'll demand another bailout. Except this time, the numbers will be so big that even the printing press won't save us. This is the illusion at the heart of modern finance. We think we live in a capitalist system where markets are free and competition is fair. But we don't. We live in a system where a handful of asset managers control the allocation of capital, the governance of corporations, and the policies of governments. And they've built that system using our own retirement savings. They've weaponized our money against us. So where does this leave us? Let me be very clear about the stakes. The 2008 financial crisis was a warning. It showed us what happens when risk is hidden, when leverage is excessive, and when institutions are too big to fail. But instead of breaking up the banks and reforming the system, we doubled down. We made the banks bigger. We gave more power to asset managers like BlackRock. And we built a global economy on even more debt, even more complexity, and even more concentrated control. The next crisis won't just be bigger, it'll be faster. Because unlike 2008, when trades took hours or days to settle, today's markets move at the speed of algorithms. Aladdin and systems like it can execute billions of dollars in trades in milliseconds. When the herd runs, it will be a stampede. And when the crash comes, there won't be time to react. Here's what I want you to understand. This isn't about conspiracy theories or shadowy cabals. This is about incentives. BlackRock isn't evil. It's rational. Every decision they make is legal and logical within the rules of the system. The problem is the system itself. We've created a financial architecture where private companies manage public infrastructure, where conflicts of interest are normalized, and where the profits are privatized while the losses are socialized. That's not capitalism. That's state-sanctioned extraction masquerading as fiduciary duty. The lesson here is about denial and borrowed time. We keep pretending that the next crisis will be manageable, that the next bailout will work, that the next innovation will save us. But every time we kick the can down the road, we make the eventual reckoning worse. And the people who will pay the price aren't the ones who built this system. It's you. It's me. It's everyone who doesn't have a seat at the table when the music stops. So what do? First, educate yourself. Understand how your retirement savings are being used. Understand who's voting your shares. Understand that passive investing isn't as passive as it seems. Second, demand transparency. BlackRock and other asset managers should be required to disclose how they vote and why. Aladdin should be audited by independent regulators. And the revolving door between Wall Street and Washington needs to be closed permanently. Third, and this is the hardest part, we need to reimagine what finance is for. Is it supposed to allocate capital efficiently and fund productive enterprise? Or is it supposed to generate infinite returns for a shrinking group of insiders? Because right now, we've chosen the latter. And that choice is killing the economy that most people actually live in. Here's my final question for you, and I want you to really think about it. Are we wiser now than we were in 2007? Or are we just walking the same path in better suits, with faster computers and bigger numbers? Drop your answer in the comments. Share this video with someone who still thinks the system is working. And if you want more breakdowns of the financial machines that run your life, hit that subscribe button. Because the truth isn't hidden, it's just boring. Until it's not.